Today, we embark on an intriguing exploration of debt, a tool that, when wielded wisely, can amplify your financial prowess. Join us as we break down misconceptions, illuminate smart debt management strategies, and explore the nuances of tax optimization. We'll also introduce you to the transformative 30% rule, a strategy that can significantly enhance your financial landscape. But first, make sure to hit that subscribe button and join our vibrant community to stay updated with actionable insights that will elevate your financial game. Understanding debt, more than just numbers. Debt often conjures up images of worry and sleepless nights. But what if I told you that understanding and managing debt could actually empower you to shape a prosperous financial future? Not all debts are monsters lurking in your finances. There are good debts that act as leverage, potentially propelling you towards wealth. Let's demystify this concept. Think of debt as a tool in your financial toolkit, not unlike a sailor's compass or map. A sailor harnesses the wind, using it to guide the ship through tumultuous seas to reach serene harbors. Similarly, you can use debt strategically to navigate towards financial stability and wealth. Key to this process is understanding the specifics of any debt you take on, be it the interest rates, the repayment terms, or potential penalties for early repayment. These details are your navigational tools, guiding you through the complexities of financial waters, helping you avoid the whirlpools that can sink your financial future. Debt isn't just about borrowing, it's about strategic financial planning. While living completely debt-free might seem like a safe harbor, it often limits your ability to seize potentially lucrative opportunities that require upfront capital. For instance, many entrepreneurs initially rely on business loans to launch their ventures. Without this type of debt, some of the most successful companies today would never have left the dock. Responsible debt management is more than just avoiding debt traps. It involves a thorough understanding of when and how to leverage debt to open doors to growth opportunities. This means not only knowing when to take on debt, but also when to avoid it. High-interest consumer debt, such as that from credit cards, often represents a dangerous financial current, best steered clear of unless absolutely necessary. Moreover, understanding the different types of debt is crucial. Secured debts, like mortgages and auto loans, typically have lower interest rates and are backed by collateral. This makes them less risky for lenders and more manageable for borrowers. On the other hand, unsecured debts, such as most credit cards and personal loans, come with higher interest rates and can pose greater risks to your financial health. Effective debt management also means knowing how to structure your debts. Using strategies like debt consolidation or refinancing can lower your interest rates and reduce monthly payments. However, these strategies require a deep understanding of financial terms and conditions to ensure they align with your long-term financial goals. In summary, by mastering the art of debt management, you can transform what many perceive as a financial burden into a powerful tool for wealth creation. This approach to debt is not about recklessness. It's about harnessing opportunities with precision and foresight. With the right mindset and strategies, debt can serve not as a chain but as a ladder, helping you climb to new heights of financial success. By seeing debt through this lens, you can shift your financial journey from one of stress to one of strategic achievement. Debunking debt myths, the power of good debt. It's crucial to understand that not all debt is harmful. In fact, strategic debts, such as those taken on for investing in real estate or advancing one's education, can significantly propel your financial advancement. These are often termed as good debts because they can lead to acquiring assets that not only appreciate in value over time, but also generate substantial income. For example, purchasing a rental property can provide you with a steady stream of passive income, while also potentially appreciating in market value. Similarly, investing in your education can dramatically increase your earning potential, enhancing your career prospects and financial stability long-term. Good debt acts much like an investment in your future. It's about spending money now to earn more money later. The concept hinges on the potential returns outstripping the cost of the debt incurred, whether it's through higher future earnings or greater asset values. Such strategic borrowing is not about immediate gratification, but about setting the stage for greater financial health and wealth. Conversely, bad debts are those that can quickly undermine your financial health. These types of debts typically involve spending on depreciating assets or on items that fail to generate income. High-interest credit card debts from impulsive purchases, such as luxury goods or lavish vacations, are prime examples. These debts not only depreciate in value immediately after the purchase, but also offer no return on investment, dragging you into a cycle of repayment that can hinder financial growth and stability. Moreover, bad debts often come with high interest rates that compound over time, making it increasingly difficult to pay off the balance. The longer these debts remain unresolved, the more they can restrict your financial flexibility, leading to a precarious financial situation where more of your income is directed towards servicing debt rather than saving or investing for the future. Understanding the distinction between good and bad debt is fundamental to managing your financial health. Good debt should be seen as a financial tool, an investment that opens doors to future wealth. By leveraging good debt wisely, you can enhance your financial portfolio and build a more secure future. Conversely, avoiding or managing bad debt effectively is crucial to maintaining financial stability and achieving your long-term financial goals. By debunking the myth that all debt is bad, we empower ourselves to make smarter, more informed financial decisions. It's about recognizing the potential of good debt to serve as a catalyst for wealth and using it judiciously to maximize our financial success. Debunking debt myths. Tax optimization, a hidden financial lever. Tax optimization, while seemingly complex, is essentially a strategic approach to managing your finances to minimize your tax liabilities within the bounds of the law. Understanding the tax implications of your debts is crucial in this process. For example, mortgage interest payments are often deductible on your tax returns. This deduction can significantly lower your taxable income, potentially placing you in a lower tax bracket and reducing your overall tax burden. Similarly, investing in tax-advantaged accounts such as individual retirement accounts, IRAs, or 401(k)s plays a pivotal role in tax optimization. Contributions to these accounts may be tax-deductible, and the growth of these investments is tax-deferred until withdrawal, which is usually during retirement when many people are in a lower tax bracket. This setup allows your investments to compound over time without the drag of annual tax payments, thereby enhancing the potential for growth. Another crucial aspect of tax optimization involves capital gains taxes. If you hold on to investments such as stocks or real estate for more than 1 year before selling, you qualify for long-term capital gains tax rates, which are notably lower than short-term rates. This strategic timing of asset sales can result in substantial tax savings, allowing you to reinvest the conserved funds into other lucrative ventures, further compounding your wealth. But tax optimization doesn't stop here. It also includes strategies like tax loss harvesting, where you sell securities at a loss to offset a capital gains tax liability. This tactic can be particularly effective in years where you might have high capital gains from other investments, helping to balance out your tax obligations. Moreover, understanding the specific deductions and credits available can be a game changer. For homeowners, beyond the mortgage interest deduction, there might be deductions for property taxes and certain home improvements. For investors, being aware of the potential to deduct investment interest expenses or advisory fees can also optimize tax situations. The overarching goal of tax optimization is to make the most efficient use of all available tax incentives to reduce liabilities and increase cash flow. This increased liquidity can provide more opportunities for investment and saving, which enhances your ability to accumulate wealth over time. In essence, by mastering tax optimization, you are not just saving money. You are making money by strategically reducing the amount of tax you pay, thus maximizing the efficiency of every dollar you earn. It's a critical skill for anyone looking to enhance their financial situation and requires a proactive approach to financial planning and a deep understanding of the tax laws that apply to your specific. Navigating good debt versus bad debt. Understanding the difference between good and bad debt is pivotal for anyone aiming to use financial leverage wisely. Good debt is typically characterized as an investment that not only increases your net worth, but also potentially generates ongoing income. This type of debt should ideally transform into a boon rather than a burden over time. Take, for example, a mortgage. Homeownership is often cited as good debt since it can lead to property appreciation and the accumulation of home equity, both of which can significantly enhance your financial portfolio. The key to classifying a mortgage as good debt lies in its potential to increase in value over time, which can outpace the interest paid, thereby yielding a net positive in the long run. However, it's important to remain adaptable to shifting market conditions and personal circumstances. In some scenarios, the flexibility of renting might outweigh the benefits of homeownership, especially in volatile or high-priced housing markets. Renting can free up capital for investing in higher yield opportunities, such as the stock market or business ventures, which might provide a better return than the real estate market. Conversely, bad debt is usually associated with purchases that depreciate quickly and do not contribute to increasing your wealth. This type of debt often includes high-interest consumer debt like credit card balances carried over from month to month, which finance discretionary spending without long-term financial gains. Such debts not only depreciate in value right after the purchase, but are also compounded with high interest rates that can exacerbate financial strains. It's essential to evaluate each debt decision by considering how it fits with your long-term financial goals and current economic situation. For instance, an auto loan might be considered good debt if the vehicle is essential for commuting to a well-paying job or if it's a business vehicle generating income. However, if the vehicle is a luxury model that depreciates quickly and offers no return on investment, the same debt could be classified as bad. In summary, differentiating between good and bad debt involves more than just assessing the asset's potential to appreciate. It requires a comprehensive evaluation of how the debt aligns with broader financial strategies and goals. This evaluation should include considerations of market conditions, personal financial stability, and the potential for the debt to either generate income or lead to financial growth. By understanding and applying these principles, you can make informed decisions that enhance your financial health and propel you towards achieving financial independence and security. The 30% rule, balancing debt and opportunities. Let's explore the game-changing 30% rule in greater depth. This prudent financial guideline advises that no more than 30% of your monthly income should be dedicated to servicing debt. Adhering to this rule is not just about keeping debt at bay, it's about maintaining a healthy balance that supports financial growth and stability. Why 30%? This threshold is rooted in a well-regarded principle of budgeting that ensures you are not overwhelmed by debt repayments, which could otherwise hinder your ability to manage other essential financial responsibilities. Keeping debt repayments to a maximum of 30% of your income helps in safeguarding sufficient funds to comfortably cover living expenses, such as housing, utilities, groceries, and transportation. More importantly, this rule supports the critical practice of saving for unforeseen emergencies. Without such savings, a single financial setback could force you into high-interest debt, undermining your financial stability. Furthermore, this rule also facilitates investing. When less of your income is tied up in debt repayments, you can potentially divert more towards investments that yield returns, such as stocks, bonds, or real estate. These investments can be crucial for long-term financial security and wealth accumulation. By implementing the 30% rule, you effectively set the sails of your financial ship to catch the optimal winds, steering you towards a future where financial pressures are manageable and growth opportunities are within reach. This rule doesn't just guide you through the present, but sets you up for success in the future, ensuring that your financial journey is both sustainable and progressive. Leveraging opportunity cost. Finally, understanding opportunity cost can further refine your financial strategy. Every financial decision involves potential trade-offs. By evaluating the benefits of one financial action over another, you can make informed decisions that maximize your financial potential. For instance, opting for a low-interest mortgage allows you to invest the savings in higher-yielding opportunities, thus expanding your financial portfolio more effectively than if you tied up all your capital in home equity.